Hello and welcome to Invest Education Hub. Today, we're going to take a deep look at one of the most popular index funds from Fidelity, the FXAIX Index Fund, also known as the Fidelity 500 Index Fund. If you've ever wondered how this fund works, what makes it so consistent, and whether it's a smart option for long-term investors, well, you are in exactly the right place. Let's dive right in.
Here's the game plan for today. We're going to start with the absolute basics. What even is a market index? Then we'll peek inside the S&P 500 itself. After that, we'll put Fidelity's FXAIX under the microscope, compare it to another popular choice called an ETF, help you figure out which fund might be right for you, and then wrap it all up with the big takeaway.
All right, so first things first. Before we can talk about a fund that tracks an index, we've got to understand what an index is in the first place. This is the foundation for everything else, so it's super important to get this part down.
You've heard this a million times, right? You turn on the news and the anchor says, "The market was up today," or "The market took a tumble." But what actually is the market? They're not talking about just one company, that's for sure. They're talking about an index. A stock market index is really just a tool. Think of it like a basket holding a whole bunch of different stocks. By looking at how that one basket is doing, we can get a quick snapshot, a big picture view of how the entire economy, or at least a big piece of it, is performing. It helps us see the whole forest instead of getting lost looking at just one or two trees.
Now here's a super important idea you need to grasp: weighting. See, not all stocks in the basket are treated equally. In most of the big indexes, like the S&P 500, the biggest companies have the most influence. This analogy nails it. A final exam is worth way more of your final grade than one little homework assignment, right? Well, it's the same thing here. A huge day for a company like Microsoft moves the whole index a lot more than a great day for a smaller company.
And that leads us perfectly to the heavyweight champion of indexes, the Standard & Poor's 500, or as everyone calls it, the S&P 500. This is the index that FXAIX is built to copy, and for good reason. It's widely considered the best single gauge of the entire US stock market.
Yep, just like the name says, the S&P 500 keeps track of 500 of the biggest and most important publicly traded companies in the United States. So, when you put your money into a fund that tracks this index, you're essentially buying a tiny little slice of all 500 of those companies at once.
Just take a look at this chart. It really shows you the diversification you're getting. Your money is spread across all these different parts of the economy: finance, healthcare, you name it. But one thing should jump right out at you. Look at that massive slice for information technology. At nearly 31%, big tech makes up almost a third of the entire index. That's huge. And remember what we said about weighting? This is where you really see it in action. Those gigantic tech companies we all know, Apple, Microsoft, Amazon, they take up a massive piece of the pie. In fact, just these top 10 companies make up over a third of the entire index. So your investment is heavily tilted towards these industry giants. Okay, so with all that background on the S&P 500, let's finally put the star of our show, Fidelity's FXAIX, in the spotlight. This is what's known as a mutual fund, and it's one of the simplest, cheapest, and most effective ways for an everyday person to invest in the S&P 500.
The whole point of an index fund is simple. It's not trying to be a hero and beat the market. It's just trying to be the market. And FXAIX does this job beautifully. If you were to draw a graph of its performance, the line would be sitting right on top of the S&P 500's line. It does exactly what it's supposed to do. No surprises.
Now, let's talk about the magic ingredient, the cost. This number right here is the fund's expense ratio, and it is the secret weapon for index funds. At just 0.015%, it is ridiculously low. Let me put that in perspective for you. For every $10,000 you have invested in this fund, you are paying a grand total of $1.50 for the entire year. It is practically free. So let's sum it up. With FXAIX, you get a fund that perfectly tracks the S&P 500. The cost is about as low as it gets. There's no minimum amount of money you need to get started. What's the catch? Well, there's just one little thing. Since it's a Fidelity mutual fund, you have to have an account with Fidelity to buy it. And that brings us to a really important point. FXAIX is a mutual fund, right? But that is not the only way to own the S&P 500. There's another incredibly popular option called an exchange-traded fund, or ETF. Just think of them as two different cars that can both get you to the exact same destination.
So what's the difference? Well, mutual funds like FXAIX only trade once a day, right after the market closes. This makes them awesome for setting up automatic, recurring investments.
You know, that set it and forget it approach, which is perfect for a retirement account. ETFs, on the other hand, trade all day long just like a regular stock. This structure can sometimes make them a bit more tax-friendly in a standard brokerage account, and you can buy them from pretty much any brokerage out there.
Okay, theory is great, but let's get practical. With all these options, how in the world do you choose the right S&P 500 fund for your personal situation?
All right, here are the heavy hitters in the S&P 500 game. You've got our fund, FXAIX, with that tiny fee. Then you've got two of the biggest ETFs in the world, Vanguard's VOO, which is still super cheap, and SPY, which is the original S&P 500 ETF, though it's a bit more expensive. And then look at this last one, also from Fidelity, FNILX. Yes, you are reading that right. That's a 0.00% expense ratio, as in free.
So, how do you decide? Look, it doesn't have to be complicated. It really just boils down to a simple three-step thought process. First, what kind of account is this for? Retirement or a regular brokerage? Second, where's your money? If you're already a Fidelity customer, their funds are a no-brainer to look at. And third, always look at the fees. Over decades, tiny differences in cost can literally add up to tens of thousands of dollars.
Okay, we have covered a ton of ground. So let's bring it all home and really focus on the single most important thing to take away from all of this.
Here's the bottom line. Investing in the S&P 500 with a low-cost fund, whether it's a mutual fund like FXAIX or an ETF like VOO, is one of the most trusted, time-tested, and straightforward strategies for building wealth over the long haul. You instantly own a piece of 500 of America's strongest companies. It's simple, it's effective, and it's powerful.
And if you're wondering why it's so powerful, this is it. Now, of course, the market will have bad years. That is an absolute guarantee. But historically, going back decades, the average annual return of the S&P 500 has been somewhere in the ballpark of 10 to 12%. That's a testament to the long-term power and growth of the U.S. economy.
So, there you have it. We've pulled back the curtain on the index, we've unpacked FXAIX, and we've laid out the different ways you can invest. The path to building long-term wealth is clearer than ever. So the only question left is, which path will you choose to take on your journey? Thanks so much for joining us at the Invest Education Hub.